Right now, inside the world's largest banks, AI systems are making thousands of decisions per second, pricing derivatives, approving loans, executing trades, flagging fraud. The humans are still there, but increasingly, they're watching, not deciding. That question is no longer rhetorical. And for the first time, global financial regulators are publicly admitting they don't fully know the answer. And they're scared. The Bank for International Settlements, the central bank of central banks, published a stark warning in 2024. So did the Financial Stability Board. The message was the same. AI has been absorbed into the financial system faster than the oversight infrastructure can handle. This isn't a warning about AI being smart enough to steal money. It's more subtle and more dangerous than that. It's about what happens when thousands of financial institutions use the same AI models, trained on the same data, and they all start behaving the same way at the same time. In financial systems, diversity is a stabilizer. When different institutions use different models, different assumptions, different strategies, they don't all panic simultaneously. Some buy when others sell. That friction absorbs shocks. AI is eroding that diversity. Think of it like crop monoculture. When every farm grows the same strain, one disease can wipe out the entire harvest. When every bank uses the same AI risk model, and that model is wrong about something, they all discover it at the same moment, and they all react the same way. At machine speed, there's a second threat layer that's more immediately terrifying: interconnectedness. AI systems at major banks don't operate in isolation. They communicate, reference the same data sources, use the same cloud providers. A cyber attack or failure at one node doesn't stay contained. It propagates. The FSB specifically flagged concentration risk in AI infrastructure. 3 cloud providers, Amazon, Microsoft, Google, run the back end for a significant share of global financial AI. That's not a technology problem. That's a single point of failure problem for the entire system. And this is what regulators mean when they talk about systemic cyber collapse. Not that a bank gets hacked and loses data, but that a targeted attack, or even a software bug, on shared AI infrastructure simultaneously disables risk management, trading, and liquidity systems across dozens of institutions at once. The 2010 flash crash lasted 36 minutes. Algorithmic trading systems interacted in ways nobody anticipated and wiped out nearly $1 trillion in market value before recovering. That was with relatively simple algorithms. Now imagine that dynamic with AI systems that are orders of magnitude more complex and more interconnected. The regulatory problem is fundamental. AI systems are often black boxes. A risk model can flag a position as safe. The bank's compliance team trusts it. The regulator reviews the output. But nobody, not the bank, not the regulator, can fully explain why the model reached that conclusion. You can't stress test what you can't understand. The BIS calls this model opacity. It's been a concern with quant models for decades. But the scale with AI is categorically different. Traditional quant models are rules-based. You can read the code. Neural networks learn patterns from data in ways that resist human interpretation. Regulators are now pushing for mandatory AI audits, explainability requirements, and concentration limits on shared infrastructure. But financial regulation moves slowly. International coordination moves even slower. The technology is already embedded. The frameworks to govern it are still being drafted. This is the pattern we've seen before, with derivatives before 2008, with mortgage securitization, with high-frequency trading. The financial system absorbs a new technology that creates new risks. The regulation catches up after the crisis proves it was necessary. The question isn't whether AI will cause a financial disruption. Regulators are already past that debate. The question is whether the disruption will be contained, a sharp correction, a temporary breakdown, or whether it will cascade in ways that make 2008 look like a rehearsal. Speaking of things that shouldn't be possible, next video, we look at how Goldman Sachs just had one of its most profitable quarters in history, while the rest of the market was bleeding. The mechanics of how that works are exactly what regulators are worried about. Subscribe. You'll want to see this one.